Hello and welcome to Big Picture. I am Vishal Dahiya, and today we will talk about the steps taken by the government to rejuvenate the economy. Now, listing the major interventions by the government to boost the economy, Finance Minister Nirmala Sitharaman has said that government will continue to take measures as and when required to boost growth. In a press conference on Friday, the Chief Economic Advisor Subramanian gave a recap of measures taken by the government since August, which include moderation of interest rate, infusion of liquidity through various means, capitalization of public sector banks, and giving last-mile funding to the reality projects. He also said that government's scheme to support NBFCs and HFCs and restarting stalled real estate projects are also likely to start disbursing funds soon. So how will these steps taken by the government contribute to rejuvenating the economy, and what more needs to be done to achieve this particular goal? For more on this, we're joined by a distinguished panel of guests. Let me first introduce the guests to you, beginning with Mr. Abhinav Prakash, the Assistant Professor in University of Delhi. We also have with us Siddhartha, the National Economic Editor of Times of India, and we'll soon be joined by Dr. Arvind Veermani, the former Executive Director of IMF. But let me begin with you, Siddhartha, and I'm sure you must have, watched the entire press conference, yesterday's press conference by the Finance Minister and the Chief Economic Advisor as well. In terms of, the steps listed by both of them, which the government has taken in the past 3 or 4 months, how do you see these measures taken by the government, and how effective do you believe they have been in rejuvenating the economy?
The steps have just been announced in the sense that, and some of it is still work in progress. I mean, for instance, they have announced a real estate fund, which is yet to, it is still taking shape. It has been put in place quite quickly. And the actual disbursals, the actual project reviews, the actual sanctions haven't happened. Similarly, there was an announcement regarding this whole 100 lakh crore of investment into infrastructure projects. Now, the finance minister had earlier said that it would be the list of projects, etc., would be, some of the details would be announced around the 15th of December. So that is something that people are looking forward to, what are the kind of infrastructure projects that the government is looking at. Now, then there are issues which were sought to be addressed in terms of, in terms of providing liquidity. Now, this in terms of providing liquidity to NBFCs, housing finance companies, accelerated depreciation for automobile purchases. Now, those are things, which are, and even that, corporate tax reduction. Those are things which will pan out over the next few months.
Okay.
So the announcements have been there. These are early days. And the criticism is that, what the government has done is not sufficient in terms of, and there is a view that they haven't addressed, how to boost consumption, which is primarily behind this whole slowdown. I mean, that's one school of thought, for which, a lot of tax cuts in terms of a GST rate reduction, or even a demand for income tax reduction on the personal income tax side is there. Now, these are things which will perk up demand. Also, consumer sentiment is very low. As you would have seen in the RBI survey recently, and other surveys also suggest that consumer sentiment is low. So these are issues which need to be addressed, and hopefully, as the finance minister said, that some of it will be addressed in the budget, which is probably on the 1st of February.
Okay. So the consumption, investment, and other aspects as well, there has to be a holistic perspective on this particular issue, and this is a work in progress, as Siddhartha is pointing out. Abhinav, from your point of view, these are some measures which the government has taken, but the government has also said that if required and as and when required, there will be more interventions. And the finance minister specifically said in terms of the credit, that if somebody has any problem, then they can approach the government.
See, if we look at this slowdown in the economy, it's basically coming from the shortage in the demand in the economy, in my opinion. And in India historically till today, the demand, aggregate demand, has basically came from the government spending and from the credit expansion. And for the past couple of years, we are seeing that they both are under stress, and not just for the past couple of years, I'd say for the past decade or so. The government is not bound by these fiscal deficit targets. So the government has restrained itself from going ahead and spending more in the public. That has automatically put a limit on what the government can do. And second point is, we have seen the problem in the banking sector because of the NPA and other things. So the credit offtake, the willingness of the banks to lend and also of the businessman to borrow has gone down. So if the government really wants to overcome this slowdown, it has to really focus on the demand side. As of now, we have seen that they have announced several schemes, several measures like the last mile connectivity for the housing sector, clearing the dues of the central public sector units. But the problem is coming from the what I will say, the income problem in the economy. So it's not just as the people don't have the jobs. The lots of people have jobs. The jobs are being created to an extent, but they're not stable long-term jobs which can stimulate the private consumption demand, because people are not sure about their future prospect. So something needs to be focused there as well, that how do you create the jobs which are, even if they are not the permanent jobs, they are flexible jobs or the contractual jobs, but they are permanent over a period of time, they are stable over a period of time. That is going to boost the economic expectation from the consumer side. From the investor side, we have seen that there has been a brilliant measure of cutting the corporate taxes. That's a very great measure by the government. But we have a problem from the monetary authorities side. The real interest rates in India continue to remain very high, and for some reason MPC and the RBI is not going aggressive on that. So I hope that going forward we see these two things. Somehow you have to address the income problem in the economy, and somehow you have to nudge the central bank to lower the real interest rate, not just the nominal interest rates.
Okay, Dr. Veermani has joined us. Dr. Veermani, from your perspective, what the government said yesterday, listing the steps, all the steps which the government is taking, some of them are work in progress as well. But as Abhinav is also pointing out, the key focus areas, according to you, what it should be? Should it be consumption and the jobs, or should it be somewhere else the government should be focusing?
See, there is what we have to remember is two things. One is this is probably the first time in many years that we have 6 consecutive quarters of GDP growth decline. We actually had 4 quarters about a year or two ago, but then it recovered very quickly. So this is fundamentally different, because instead of recovering after a couple of quarters, it has continued to go down. Secondly, we should remember is that 4.5% GDP growth is roughly down about 30%, depending on which average you take, between 25 and 33% below the average for many years. So it's a fundamentally problematic thing. Now it is not the earlier one we had was the global financial crisis, but that was it is not comparable to that, but probably since then it is leaving that aside, is probably one of the worst we have had. So it becomes very essential to understand, and basically there are 3 kind of underlying things, and then there was a trigger which set it off. So we can very quickly go over that, please, if you have a little time. So we've had a lot of institutional changes. As I said, the 3 main ones were, one, this campaign against black money. Now it's not just everybody talks about demonetization, but it's not demonetization per se, but a whole bunch of things, starting from SIT, a number of laws, Benami, foreign assets, etc., RERA, and a whole bunch of other things, culminating in the demonetization. So that has been a fundamental institution change which has put pressure on the black economy. The hope was the black will shift to the white, and therefore it will fully compensate and the GDP will keep growing thing. It hasn't, because of the 2 other factors which have been there. One is the fiscal. Given these facts and the global deflation, there was a pressure for raising taxes. So instead of making it easier, the government put more taxes on the white economy. So the whole thing kind of collapsed. And the third factor is the monetary, which has been mentioned earlier, which a whole bunch of earlier credit excesses, etc., which then when we started tightening, so we had an institutional change, setting up MPC, inflation targeting, etc., and even the governor at the same time, the Governor Rajan, started tightening the norms, etc. Now each of these things may by itself have been good, but taken, all these 3 things taken together, then partly resulted in that financial crisis and kind of a collapse of GDP. So what do we need to do? We really need to address all three of these things. You already mentioned a few good steps which the government has taken. The most important in my view is the corporate tax reform, but also bringing forward these expenditures, etc. is already mentioned. I won't mention it again. The second is that the credit, what I call the clogging of the credit channels, that has to be sorted out. You know, when you get this huge shock, when it's a little question of 5-10% is different. But like I said, it's 25 to 33%, and the danger is you get into a negative spiral, you know, that clogging of the credit channels, worsen GDP growth, worsening GDP growth brings more NPAs, etc. So
and you have to get out of that spiral.
Yes, you have to get out of it by doing everything you can. You know, you can't talk about vague things. Again, they are valid in itself, like moral hazard, etc. But those are things for longer term and for non-crisis situations. You have to just get in there. Again, government and RBI has started acting, but I think the whole problem has not been solved yet, but I'm hopeful it will get solved. And finally, the third thing is that you have to address this, all this uncertainty has been created now, because you know, you were happily going along at, let's say, 7 to 7.5% growth, but now you are at such a low level that a lot of uncertainty, risk aversion arises. So you have to do what we have discussed before, structural changes. You know, whether it's labor reform, land, we can discuss further, but all those kind of agricultural reform, liberalization of external, etc., which will give confidence to the private markets, etc., to get back in, to forget this bad period and look forward to a better period in the future.
Okay, so that confidence has to be brought back, and the investors and the private players need to have that confidence. Let me go back to Siddhartha. Siddhartha, do you agree with the stipulation made by Dr. Veermani in the points that, you know, one, it is that spiral and those three reasons which he has pointed out behind this decline in the GDP, and you know, the second is that we need to go ahead and tackle the uncertainty aspect which is hovering around everything which relates to economy?
Yeah, I agree with him. I mean, state governments aren't helping the cause. I mean, you have a situation in Andhra Pradesh and now in Maharashtra, where, you know, the new state governments that have come in, have been elected, have, you know, done away with things which had been announced, and these are contractual obligations. So, you know, that has created a huge uncertainty, and there is very little that, you know, that the center can do. Now, having said that, I would like to add 2 or 3 more things to this. You know, a part of the problem is that, you know, the government hasn't done its bit. You know, one of the reasons which is holding back interest rate transmission that RBI had initiated were the small savings rate. You know, you are artificially paying higher interest rates on, you know, PPF and post office deposits and things like that. And people naturally, banks are wary of, you know, cutting down on their fixed deposit rates. So that is holding back monetary transmission. I mean, if you look at the deposit rate reduction, on an average, it's been about 50 basis points. I mean, this was in the RBI MPC statement, whereas RBI has reduced rates by 135, had done it by 135 basis points. On its part, if you look at PPF, etc., the government has done reduced it by 10 basis points, whereas the market rates, which is what these small savings rates are linked to, should have guided this change. Number one. Number two, you know, the government needs to forget this whole fascination of 3% fiscal deficit for the time being. You know, we have a situation where you know, this 3.3, 3.5, 3.7, whatever the number is there, doesn't really capture the entire fiscal deficit. I mean, you look at the dues of Food Corporation of India, which is not included here. You look at other items, you know, there were oil bonds which were issued, you know, these were all below the line items. Now we are fooling ourselves by saying that we have 3.4% fiscal deficit, whereas actually the centre's fiscal deficit would be much higher. Okay. Now, this is an unprecedented situation if you look at it in the last 6-8 years. So you need to, and where private investment is not happening, so you need to forget fiscal deficit for the time being, loosen it a little, and then be prepared to roll back that stimulus in the months ahead, and be quick in rolling back, unlike what Mr. Pranab Mukherjee did when he, you know, forgot to roll back the stimulus, which created a whole set of problems. Third, you know, what the government is doing in terms of restricting imports is going to be catastrophic. it's one, it's anti-consumer, and two, it raises the cost of production.
Okay.
So I mean, this whole, this newfound fascination for import substitution by raising import duties is not going to help the cause. So these are some of the things that I think should be added to that wish list.
Okay. Okay, so quite an important points, 2-3 out there, specifically from the fiscal deficit aspect. If you look at it, Abhinav, let's not also lose sight of the fact that next week onwards, the consultations on the budget will begin, and it's not too far away, almost a month and a half before the new budget is presented. So the government and the finance minister will also have this task of carrying on with the interventions which have been made so far, carrying on this work to try and ensure that the budget also presents a picture which, as Dr. Veermani also pointed out, goes towards resolving or finding solutions or answers to the hurdles which are there right now.
I agree. I mean, before I come to that, I just want to add something to which Mr. Veermani was talking about. See, for the past several years, our both monetary policy and the fiscal policy have been moving in the same direction, the contractionary policy. So the interest rates were high and the fiscal deficit was also not increasing. Now I think the time has come, and with the budget coming, that we need to follow an expansionary fiscal policy and both expansionary monetary policy together. I mean, the previous panelist was talking about that we need to, for the time being, let go of this obsession with this 3% target of the fiscal deficit. The fiscal deficit in itself is not a problem, apart from that it affects the global investment sentiments of the financial flows. The quality of the fiscal deficit matters. So if you're running a higher deficit, doing a proper investment, investing in the long term infrastructure or the resource generating activities is not a problem in itself.
Okay.
So we need to forget this obsession with the fiscal deficit going forward in this budget, and also the monetary policy, and also the government needs to take a call that it needs to prioritize growth now rather than the inflation targeting. I know the inflation is a very politically sensitive issue in India. We have seen in the terms of onion prices as well, but you need to sacrifice one, right?
So in the longer run.
No, I mean, if you want to push up the growth, the inflation will definitely rise.
Okay.
High growth always goes with the higher inflation. So we are too focused on the inflation targeting, and we are sacrificing growth at the macro level. The micro level things are different, but at the macro level we need to focus more on growth and let's tolerate some moderate inflation for the time being.
Okay. Dr. Veermani, do you agree with this suggestion coming in from both the panelists that we can, for the time being, take our eyes off from the fiscal deficit target and that 3% number which is there?
So let us look at the forthcoming budget. I think I didn't mention two very, very important measures which are absolutely essential. I said that the black economy had gone down, but the white economy had not picked up sufficiently compensate for that. There are two critical things which you have to do for that. One is the direct tax code, which is most important for small businesses. Because when we talk about the direct taxes, we only think of people like us who are salaried, but that's not the importance of that code. That code affects all small businesses in the country because that is how they pay their taxes. So in my view, it is absolutely critical that all the recommendations are there, there's a committee implemented, everything is there. There must be a strong step towards that. Now, some of the fiscal aspects of it which can be separated, like surcharges and all, can always be phased out. And the second is the GST, which in fact the complex GST, as we have discussed here also earlier, has actually affected these small businesses and trade the most, and also has contributed to the problems which I mentioned, with the shock and the decline. So given that, what does that mean? Does that mean that all these things which may increase the deficit should be countered? Absolutely not. Whether we put it in the form of quality of deficit as he's talking it, or put it in terms of the where I prefer to do is the short term effects versus the long term effect of that. So I think the key in my way of analyzing it is that the short term deficit increase is a positive factor, especially if you keep the long term thing in view. And I can tell you the way credit markets look at it, if you have a corporate tax reform, if you have a direct tax code reform, if you have a GST reform, that is a huge long term positive for the fiscal deficit in the way the credit markets looked at it. So it's that balance, you know. And of course, you have automatic stabilizers. That is, your GDP growth was assumed to be 11% nominal. It is down to 6 right now. Maybe it will recover a little bit. But that is an automatic stabilizer. You do not compensate it by putting more taxes and reducing expenditure. That's the whole job of automatic stabilizer. So it's how you look at it.
Okay.
The fact that you shouldn't worry about the fiscal deficit doesn't mean you should do wasteful expenditures, because that will have a negative
But in the
effect.
short term,
yes, that will have a negative effect. If you do effective, solid infrastructure investment, as was suggested earlier, is quite right. So it all depends on how you go about it, which increases your credibility in the eyes of the capital market.
Okay. Okay. Siddhartha, on one aspect which Dr. Veermani has pointed out in terms of, tax reforms, and as Dr. Veermani is saying that now that the budget is around the corner, the government should think and try and do something about the direct taxes, about the GST structure, tax structure as well, to ensure that there is a proper balance out there.
Yeah, certainly there's no dispute over that. These direct tax reforms are long overdue. We've moved on the corporation tax side, and it is more out of this whole competition to get investment. I mean, you look at the World Bank data globally, that's the phenomena, that corporate tax rates have come down. But if we look at that curve, what workers pay in terms of the personal income tax, it's flat. So globally too, you have seen the corporation tax curve come down, but the other curve stays there. But having said that, there is no denying the fact that we need to move on the direct tax side. It is too complicated, I mean, from an individual's point of view. But politically, are we ready to, pull the plug on all these exemptions that you get, that 1.5 lakh for investing in, 5-year fixed deposits, or in PPF and things like that? I don't think we are ready for that politically or as a society. We are obsessed with these concessions, which in the original direct tax code as it was conceived would go away. Two, in terms of GST, by all accounts, the government is going to move in the other direction. It's going to, increase the 5% rate to 8%, 10%. But at the same time merge that 12 and 18% rate. But overall, because it is there, it is unwilling to give away on any revenue, that potential revenue that may come. So the government is probably going to move in the other direction as early as this week, or in the coming months for sure.
Okay. Okay. So there it is, as has been pointed out by, thank you Siddhartha, thank you Dr. Veermani and Abhinav there as well. As far as the economic situation is concerned, the government is doing as of now what it can in terms of measures taken in the short term, with a short-term perspective and a mid-term perspective as well. Some of them will take time to show effects, but as our panelists point out, the government will also have to look at the holistic picture here. And now that the budget is around the corner, maybe try and find the solution in some more aspects to rejuvenate the economy. We'll come back again on Monday with a different topic and different set of guests. Till then, keep watching Rajya Sabha Television.